In 2024 alone, gold prices have soared an impressive 28.13% year to date, following a strong 13.8% gain in 2023. With numbers like these, it's no surprise that many investors are considering adding gold to their portfolio. Or are they all wrong? However, as the S&P 500 reached another all-time high this year with a 22.5% increase, concerns about the potential economic crisis are also growing. This raises an important question. Is gold a smart asset to buy, and does this shiny metal truly hold its ground as a wise long-term investment? These are some of the reactions that I have found online. The economic crisis and downturn are all the signs of a 2008 market crash 2.0. So my question is, do I still save in the US dollar, or is it okay to move all emergency and savings to a precious metals? Another one is from a retired gold miner who says in the early 2000s gold was just above $250. You do the math, gold hasn't changed in buying power, but the dollar has. Or my friend has been telling me for years that putting money in gold is foolish. He hasn't said much recently. So in situations like this, it's crucial to dive deep into the data as it often holds the clearest answers. But before we get into the numbers, let's turn to a true expert with 68 years of investment experience. Jack Bogle, a legendary figure in the world of finance, shares valuable insights on whether gold is a smart investment or not. Let's hear what he has to say.
How would you advise investors looking at commodities right now? I mean, there's been such a rush into gold, especially lately, but really over the past few years. Is gold at these levels a wise investment for an average investor?
Well, I think no. And the reason I say no is gold is not an investment at all. Gold, to go back to where we started, Poppy, is a speculation. It has absolutely no underlying intrinsic value. You know, bonds are ultimately supported by interest coupons. Stocks are supported by dividend yields and earnings growth. And gold is supported by, well, the ability to think somebody else is going to take it off your hands for more than you paid for it. It doesn't have an internal rate of return. So it's a speculation. Is it a good speculation today? I don't know that I'd be much of an expert on that, but it's gone so high so far that I'd be very skeptical of it. But if you really are bitten by the gold bug, and it seems like an awful lot of people have been bitten by the gold bug, and if you want to speculate, maybe 1 or 2 or 3 or even 5% of your assets in gold is not the worst idea in the world, but I wouldn't do it myself, and I wouldn't advise most investors to do it. Well, I mean, I think you should invest for the long term. And if you're investing for a lifetime or for the next 15, 20 years, whatever it might be, in that period, looking ahead, there are going to be a certain number of recessions, a certain number of booms, a certain number of good times and some bad times. That's the way the markets are. And to try and get in at the bottom and out at the top is simply impossible for anybody. But it's a very good bet that stocks will do significantly better than bonds over the coming decade.
First of all, let me clarify what Jack Bogle exactly means when he says that gold is merely a currency without any underlying value. But before we delve into the details, let's take a moment to explore some key facts about gold's history. Because gold's journey began long before the ancient Egyptians, who used it to create jewelry and religious artifacts. Therefore, it was until around 560 before the Common Era that gold began to function as currency. At that time, merchants sought a standardized and easily transferable form of money to simplify trade. So the solution was gold coins stamped with a seal, which became widely accepted and valued around the world. As the centuries progressed, gold evolved to symbolize wealth across Europe, Asia, Africa, and the Americas, a status it continues to hold till today. So historically, gold has been primarily used as a form of money. But unlike modern investments, gold doesn't produce anything or generate income, and that's a big difference if you compare gold with stocks. For example, if you own stock in Apple, when a new iPhone is released, the company profits from its sales. and as a shareholder you benefit from the potential increase in Apple's value. Stocks like Apple can pay you dividends or grow in value as the company succeeds. Gold, on the other hand, works differently. It doesn't create or produce anything and doesn't pay dividends. Its value only increases if more people want to buy it. Gold has remained valuable because it's scarce. There's only a limited amount of it. And it has universal appeal, meaning people across cultures recognize and value it. But as Jack Bogle pointed out, gold doesn't give you regular payments like bonds or some stocks do. But when you own gold, you are holding a physical asset whose price depends solely on market demand. It could go up or down based on how much people want it. And this highlights a key difference between gold and other investments. While stocks and bonds provide regular income and returns based on the company's performance, gold's value depends purely on market conditions and demand. So let's hear what another investment guru, Warren Buffett, has to say about gold. Buffett is also known for his long-term investment strategy and value-driven approach. Buffett has strong opinions on gold as an investment.
Gold would be way down on my list as a store of value. I mean, I would much prefer owning 100 acres of land near here in Nebraska, or an apartment house, or an index fund. Gold, we'll say, was freed up 30 odd years ago, but it adjusted to a market that still, if you go back to 1900, you were talking $20 gold. Well, you take 20 to 400 in 100 years. The Dow went from 60 to 12 or 13,000, and then 12,000 or whatever it might have been in that same period, and paid you dividends during the time you owned it. It was 66, I think, at the start of the century, and I forget what it ended, but it's 11 or 12,000. And like I say, it was paying you something every quarter during that period. And if you own gold, you paid $20 in 1900 or thereabouts, and then we'll say you had it $400 100 years later. And in the meantime, you paid insurance and perhaps some storage cost. It really is not a store of value, and I'm not arguing for paper money, but if you're worried about paper money, and I think it makes a lot of sense to worry about paper money over long periods of time, but it's just about the last thing I would want to own under those circumstances. A farm has utility, an apartment house has utility, a business will produce earnings, and to some businesses will produce them in real terms as they go along. I'd rather have the ability to sell people a pound of candy 20 years from now, and if they're dealing in seashells, I'll get an appropriate number of seashells instead of paper money for it. But I don't see gold as a store of value, and the truth is it hasn't worked very well. But forget about whether it's worked well the last 100 years or the last 50 years or the last 10 years. I see no reason, why it would work well in the future. I forget whether we're turning out about 3,000 or 4,000 tons of gold a year. We take it out of the ground in South Africa and we put it in the ground at Fort Knox or someplace, or in the New York Fed. I mean, and it doesn't do much along the way for anybody. So I don't know, Charlie, how do you feel about gold?
Well, I think gold and similar items, that was a great thing to have if you were a well-to-do Jewish family in Vienna in 1935, because you had hazards where that gold had enormous utility to you. But for Berkshire Hathaway sitting here in 2005, it just doesn't interest us at all.
So, does this mean that gold doesn't provide returns, especially in the long term? Not so fast. In fact, since August 15, 1971, when President Nixon removed the US dollar from the gold standard, the price of gold has surged from an average of $36 in 1970 to 2080 in 2023. Over that period, gold's annual return has been approximately 7.95%. For comparison, the purchasing power of $1 in 1970 is about $7.72 in 2023, representing an annual return of roughly 4%. Now let's consider how gold stacks up against the S&P 500. If you had invested $100 in cash, gold, or the S&P 500 back in the 1970s, your S&P 500 investment would have grown to an impressive $22,000, far outperforming both gold and the dollar in terms of long-term returns. But here is where it gets interesting. What happens when the stock market suffers big losses? Specifically when US equities experience drawdowns of more than 15%. This is where gold can play an important role in diversifying a portfolio, helping spread risk and protect your money during market downturns. Gold has often performed well compared to other assets, especially under different economic conditions. One key reason is that gold doesn't always move in the same direction as stocks and bonds, offering a hedge during tough times. For example, when the stock market faced significant trouble and lost value for more than 15%, gold historically provided an average return of 7.18%, while the S&P 500 index dropped about 23.5% during similar tough times. In these downturns, gold has demonstrated its ability to hold or even increase its value during various financial crises and uncertain situations. However, we cannot exactly time these markets or predict these uncertain periods, right? So if your focus is on short-term diversification, gold is not correlated with stocks, bonds, or real estate. And this means that even if all other assets are declining, gold can often serve as a relative safe haven. That said, in my opinion, if you have a long-term investment horizon, you are likely better off with stocks than with gold. Stocks represents companies that produce value, generates profits, and can grow over time. Whereas gold is a static asset that doesn't create anything or generate income. Now that we discussed the pros and the cons of investing in gold, let's shift our focus to building a diversified portfolio with great returns. Diversification is key when it comes to minimizing risk and maximizing returns over the long term. So if you are curious about the best 3 ETF strategies to help you achieve this balance, you won't want to miss what's coming next. In this video, we will break down the top ETF that offer a powerful, balanced approach to investing and explain why this combination can help you build lasting wealth. See you in the next video.